Item 2. Management's discussion and analysis of financial condition and results of operations. Sadot Group Inc. is our parent company and is headquartered in Burleson, Texas. During the 3 and 6 months ended June 30th, 2026, we reported $0.0 million and $0.0 million commodity sales revenue, respectively, compared to $114.3 million and $246.5 million in the prior year periods, respectively. This reflects the significant streamlining of our operations, including the closure of certain international offices and the completion of the sale of our Sadot Food Services segment on December 4th, 2025. As of June 30th, 2026, Sadot Group consisted of one distinct operating unit and one discontinued operation. Our revenues have historically been derived from commodity sales. Revenues from commodity sales have declined substantially since Q2 2025. We generated no commodity sales revenue in the first 2 quarters of 2026 as we continue to evaluate and streamline our agri-food operations following the divestiture of our food services business and the adverse judgment regarding our Zambia farm operations. The business has experienced significant trading difficulties around capital to support new trades, disputes on settlement of existing trades, and a number of legal disputes on historic trades. Following the financial performance during the 3rd quarter of 2025, management of the company began evaluating alternative business lines to address this situation. All options are being assessed. The management continues to focus on monetizing the current assets of Sadot Agri-Foods as efficiently as possible. It should be highlighted that the risk of future impairments on current assets is a possibility going forward. Impairments on assets of the trading business cannot be excluded in the near future or in the long run. For the periods ended June 30th, 2026 and 2025, negative $0.3 million and $0.9 million, respectively, are recorded as stock-based expenses in the accompanying unaudited condensed consolidated statements of operations and other comprehensive income/loss. Net loss attributable to non-controlling interests was $0.0 million for the 3 and 6 months ended June 30th, 2026 and 2025, respectively. During the year ended December 31st, 2023, the company created a joint venture in Zambia in which the company has a 70% interest and the third-party equity ownership has a 30% non-controlling interest. As described above, following the December 11th, 2025 judgment by the High Court for Zambia, the company lost possession, control, and ownership of the underlying farmland assets, which have been fully impaired. However, the company retains a controlling interest in the Zambian entity and therefore continues to consolidate the entity. The company is appealing the judgment. The company acquired intangible assets with a carrying amount of $11.0 million during the 2nd quarter of 2026, representing a substantial majority of the company's total assets as of June 30th, 2026. Determining the useful life of these assets requires significant judgment, including judgments about the expected period over which the TradeOS platform will contribute to future cash flows, the rate of technological obsolescence in commodity trading and risk management software, and the level of ongoing development expenditure required to keep the platform commercially viable. The company assigned a useful life of 5 years. A shorter useful life would increase amortization expense in each period and reduce the carrying amount of the assets more rapidly. The company assesses the recoverability of its intangible assets whenever events or changes in circumstances indicate that the carrying amount may not be recoverable. That assessment relies on estimates of undiscounted future cash flows expected from the use of the assets. The purchased assets have not yet generated revenue, and the company's ability to realize their carrying amount depends on successfully deploying the TradeOS platform, which in turn depends on the company obtaining additional capital. These estimates are inherently uncertain, and the assumptions underlying them are consistent with those used in the company's going concern assessment. An adverse change in those assumptions could result in a material impairment charge. Our gross loss profit totaled $0.0 million and $5.0 million for the 3 months ended June 30th, 2026 and 2025. The $5.0 million decrease is primarily attributed to a decrease in commodity sales, partially offset by a decrease in cost of goods sold. We generated commodity sales of $0.0 million and $114.3 million for the 3 months ended June 30th, 2026 and 2025, respectively. This represented a decrease of $114.3 million. This decrease is due to Sadot Agri-Foods being unable to enter into additional trades because of lack of working capital. Cost of goods sold for the 3 months ended June 30th, 2026 totaled $0.0 million, compared to $109.4 million for the 3 months ended June 30th, 2025, respectively. The 100% change is a direct result of the decrease in sales. Depreciation and amortization expenses for the 3 months ended June 30th, 2026 totaled $175,000 compared to $27.0 thousand for the 3 months ended June 30th, 2025, respectively. The $148.0 thousand increase is attributed to amortization of the TradeOS platform intangible assets acquired during the second quarter of 2026. Stock-based expenses for the 3 months ended June 30th, 2026 totaled $265,000 compared to negative $419,000 for the 3 months ended June 30th, 2025, respectively. The $684,000 decrease in stock-based expenses is primarily the result of the termination of the service agreement with Agia, entered in November 2025. Sales, general, and administrative expenses for the 3 and 6 months ended June 30th, 2026 totaled $0.9 million and $3.1 million, respectively, compared to $2.8 million and $5.9 million for the 3 and 6 months ended June 30th, 2025, respectively. The $1.9 million and $2.8 million, respectively, decrease was primarily attributable to lower personnel-related costs resulting from a reduced staff count, as well as reduced operating and consulting expenses due to Sadot Agri-Foods being unable to enter into additional trades because of limited working capital availability. Other income for the 3 months ended June 30th, 2026 totaled $40.9 million income, compared to $1.4 million expense for the 3 months ended June 30th, 2025, respectively. The other income was primarily attributable to the recognition of gain on deconsolidation of Sadot Latam of $42.4 million, loss on litigation of $0.5 million, all of which were not present in the prior year, partially offset by a $0.5 million increase in interest expense. Our gross loss profit totaled $0.0 million and $11.0 million for the 6 months ended June 30th, 2026 and 2025, respectively. The $11.0 million decrease is primarily attributed to a decrease in commodity sales, partially offset by a decrease in cost of goods sold. We generated commodity sales of $0.0 million and $246.5 million for the 6 months ended June 30th, 2026 and 2025, respectively. This represented a decrease of $246.5 million. This decrease is due to Sadot Agri-Foods being unable to enter into additional trades because of lack of working capital. Cost of goods sold for the 6 months ended June 30th, 2026 totaled $0.0 million, compared to $235.6 million for the 6 months ended June 30th, 2025, respectively. The 100% change is a direct result of the decrease in sales. Depreciation and amortization expenses for the 6 months ended June 30th, 2026 totaled $175.0 thousand, compared to $54.0 thousand for the 6 months ended June 30th, 2025, respectively. The $121.0 thousand increase is attributed to amortization of the TradeOS platform intangible assets acquired during the second quarter of 2026. Stock-based expenses for the 6 months ended June 30th, 2026 totaled $94,000, compared to $1.8 million for the 6 months ended June 30th, 2025, respectively. The $1.8 million decrease in stock-based expenses is primarily the result of the termination of the service agreement with Agia, entered in November 2025. Sales, general, and administrative expenses for the 6 months ended June 30th, 2026 totaled $3.1 million, respectively, compared to $5.9 million for the 6 months ended June 30th, 2025, respectively. The $2.8 million decrease was primarily attributable to lower personnel-related costs resulting from a reduced staff count, as well as reduced operating and consulting expenses due to Sadot Agri-Foods being unable to enter into additional trades because of limited working capital availability. Other income for the 6 months ended June 30th, 2026 and 2025 totaled $38.6 million and $2.2 million expense, respectively. The other income was primarily attributable to the recognition of gain on deconsolidation of Sadot Latam of $42.4 million, loss on litigation of $0.6 million, all of which were not present in the prior year, partially offset by a $0.9 million increase in interest expense net. As of June 30th, 2026, we had a working capital deficit of $13.6 million, an increase of $41.2 million from $54.8 million as of December 31st, 2025, and cash of $0.12 million. Current liabilities significantly exceed current assets, driven primarily by $8.5 million in accounts payable and accrued expenses, and $5.2 million in current notes payable, net of discount. Substantially all of our outstanding debt obligations matured on December 31st, 2025, and, except for new obligations settled through the issuance of common stock in April, May, and July 2026, remain unpaid, placing us in default. These defaults, together with the working capital deficit, raise substantial doubt about our ability to continue as a going concern within 1 year after the date these financial statements are issued. See Note 2 to the condensed consolidated financial statements for additional information. On May 5th, 2026, we received a notice from NASDAQ indicating that we no longer satisfy the minimum shareholders' equity requirement under NASDAQ Listing Rule 5550B1. A compliance plan was submitted within the required 45-day period. On August 3rd, 2026, the company received a letter, the compliance letter, from the Listing Qualifications Department, the staff, of the NASDAQ Stock Market LLC, NASDAQ, notifying the company that, based upon the company's current report on Form 8-K dated July 17, 2026, the staff has determined that the company complies with the minimum stockholders' equity requirement for continued listing on the NASDAQ Capital Market set forth in NASDAQ Listing Rule 5550B1. As previously disclosed, on May 5, 2026, the staff notified the company that it did not comply with the minimum $2.5 million stockholders' equity requirement of NASDAQ Listing Rule 5550B1, and that it did not otherwise satisfy the alternative continued listing standards of at least $35 million market value of listed securities set forth in NASDAQ Listing Rule 5550B2, or $500,000 of net income from continuing operations set forth in NASDAQ Listing Rule 5550B3. The company thereafter submitted a plan to regain compliance to the staff and, in its current report on Form 8-K dated July 17, 2026, reported, among other things, the company's pro forma stockholders' equity after giving effect to the previously disclosed transactions described therein. The compliance letter further provides that if the company fails to evidence compliance with NASDAQ Listing Rule 5550B1 upon filing its periodic report for the period ended September 30, 2026, the company may be subject to delisting. In that event, the staff would provide written notification to the company, and the company would have the right to appeal the staff's determination to a NASDAQ hearings panel. There can be no assurance that the company will evidence compliance with the stockholders' equity requirement upon the filing of its periodic report for the period ended September 30, 2026, or that the company will otherwise maintain compliance with the other continued listing requirements of the NASDAQ Capital Market. The compliance letter has no immediate effect on the listing or trading of the company's common stock, which continues to trade on the NASDAQ Capital Market under the symbol SDOT. As of June 30, 2026, current ratio, which equals total current assets divided by total current liabilities, was 0.01, and decrease of 0.04 compared to current ratio of 0.05 as of December 31, 2025. As of June 30, 2026, working capital deficit, which equals total current assets less total current liabilities, was $13.6 million, a decrease of $41.2 million compared to working capital deficit of $54.8 million as of December 31, 2025. The improvement in the current ratio and the decrease in the working capital deficit were primarily due to the deconsolidation of Sadot Latam. While the company maintains a base of current assets, including inventories and receivables, the timing and certainty of converting these assets into cash has presented operational challenges and led the business to participate in several transactions during the second quarter of 2026. The company is currently experiencing delays in converting receivables into cash, which has impacted the timing of available liquidity. Management continues to actively manage collections, review credit facilities, and negotiate repayment arrangements with certain creditors to support liquidity requirements. The September 23, 2025 Helena Purchase Agreement provides potential access to up to $10 million, but carries material cash obligations. $100,000 liquidated damages per 30-day period if the $2 million threshold amount is not met within 6 months of registration effectiveness, plus 2.0% monthly penalties for registration delays. These cash payments, combined with the company's negative working capital $54,801,000 as of December 31, 2025, and debt maturities, increased liquidity pressure. The registration statement was initially filed but subsequently withdrawn. The original filing deadline was October 8, 2025, with the Form S-1 ultimately filed on November 14, 2025, and an effectiveness deadline of December 23, 2025. As a result of not meeting the required timelines, a penalty equal to 2% of the commitment amount was incurred, payable on the date of the triggering event and continuing on a monthly basis thereafter. As of June 30, 2026, the company has accrued approximately $1.8 million related to these penalties, which is included in accrued expenses. Subsequent to June 30, 2026, a settlement was reached whereby the company paid Helena for $350,000 and the agreement was canceled. On November 20, 2025, the company entered into a settlement agreement with Agia LLC FZ that requires a cash payment of $75,000 and the issuance of 1,050,000 shares of common stock. The company has issued 257,000 shares in December 2025, with the remaining 793,000 shares issued in May 2026 after we received shareholder approval under NASDAQ Rule 5635D. As of June 30, 2026, the company has no accrued liability as all shares have been issued. The settlement also resulted in the cancellation of outstanding promissory notes previously issued to Agia. From a liquidity perspective, the settlement required a modest cash outflow of $75,000 with no additional contractual cash obligations and therefore does not represent a significant ongoing use of cash resources. For the 3 and 6 months ended June 30, 2026, net cash used in operating activities from continuing operations was $716,000 and $1.5 million, respectively, compared to $2.4 million and $5.4 million used in operating activities for the 3 and 6 months ended June 30, 2025, respectively. There were no operating cash flows from discontinued operations in the 2026 periods. Net cash provided by operating activities from discontinued operations was $116,000 and $124,000 for the 3 and 6 months ended June 30, 2025, respectively. Our net cash used for the 3 and 6 months ended June 30, 2026 was primarily attributable to our net income of $40.1 million and $35.2 million, respectively, which included a non-cash gain on deconsolidation of subsidiary, offset by net non-cash income in the aggregate amount of $41.5 million and $39.9 million, respectively, and $782,000 and $3.3 million, respectively, of net cash provided by changes in the levels of operating assets and liabilities. For the 6 months ended June 30, 2025, our net cash used was primarily attributable to net income of $1.1 million, adjusted for net non-cash expense in the aggregate amount of $2.8 million, and $9.3 million of net cash used in changes in the levels of operating assets and liabilities. For the 3 and 6 months ended June 30, 2026, net cash provided by investing activities was $16,000 and $16,000, respectively, arising entirely in the second quarter. Net cash provided by investing activities for the 3 and 6 months ended June 30, 2025 was nil and nil, respectively. For the 6 months ended June 30, 2026, net cash provided by financing activities from continuing operations was $953,000, consisting of proceeds from notes payable of $1.0 million and proceeds from the issuance of preferred stock of $145,000, partially offset by repayments of various other notes payable of $182,000 and payment of debt issuance costs of $10,000. For the 3 and 6 months ended June 30th, 2025, net cash provided by financing activities was $864,000 and $4.0 million, respectively, consisting of proceeds from notes payable of $5.4 million and $10.0 million, respectively, partially offset by repayments of various other notes payable of $4.6 million and $6.0 million, respectively. Net cash used in financing activities from discontinued operations was $22,000 and $42,000 for the 3 and 6 months ended June 30th, 2025, respectively. There were no financing cash flows from discontinued operations in the 2026 periods.